Welcome to Driving Alpha, where we feature our friends, the outperforming investors who demonstrate their path to driving alpha or outsized investment returns. We're Alpha Partners, where we partner with 1,000 early-stage venture firms as their opportunity capital to invest in their best companies. Driving Alpha is supported by Affinity, provider of the CRM for the private capital relationship economy. Affinity knows who has the best relationship with the right startup. Affinity knows. Learn more at affinity.co/driving alpha.
Welcome back to Driving Alpha. I'm Steve Brotman, and today we're joined by Chris Farmer, a true innovator in the venture capital world. Let me give you a quick rundown of Chris's background. He's the founder and CEO of SignalFire, which is a cutting-edge VC firm that's redefining investment strategies with its data-driven approach. Before launching SignalFire in 2013, Chris honed his skills at some of the most prestigious firms in the industry, including General Catalyst. He earned his bachelor's in international relations and business at Tufts. And at some point, he was actually on Wall Street at Cohen & Company in their private equity group before founding an investment advisory service for angel investors and private equity funds. So his journey through the VC world actually started at Bessemer Venture Partners and then went on to General Catalyst, where he led seed stage investments in game changers like Coinbase, Discord, and Stripe. But Chris isn't just about big firms. He got his operational experience too, managing a firm called Skybits as their VP of Management and Business Development. With over 15 years in the industry, Chris has developed a unique blend of entrepreneurial experience and investment acumen. Today, we'll dive into how he's leveraging his expertise at SignalFire to revolutionize the VC landscape. Welcome, Chris.
Thank you so much for having me. It's a pleasure.
Super. I appreciate your coming on. Let's get started a little bit. So your path, your backstory, and how you got into venture capital. How did that winding road take you to SignalFire? Just briefly, if you could share that.
I come from a relatively untraditional background. I grew up overseas and was very interested in international relations. So I went to Tufts and the Fletcher School of Law and Diplomacy, which is, of course, where every good VC goes. And from there, I was very interested in sort of the implications of the internet on labor markets globally and international trade. So I wrote my thesis in college on that, discovered venture capital in the course of that journey and never looked back. So I never met a venture capitalist at the time, but it was the perfect intersection of my interests in entrepreneurship, investing, and strategy, and all those types of things.
Right. And I think we first crossed paths when you were at Bessemer, if I'm correct.
Yeah, it's been quite a journey. Yeah, I was in Bessemer, 06 to 08, something in that time frame, 05 to 08. And yeah, and it was a fantastic place to learn the ropes of venture capital. The alumni network there is spectacular, and there are lots of great people there as well.
No, it's remarkable. I would say that, you've always struck me as someone who's a very deep thinker, not just about investing in a particular company, but also in many ways is sort of thinking about the industry, the venture capital industry overall. And I think as we get older, you start thinking about that a lot more as time goes on.
Yeah.
And, tell me how sort of the idea for SignalFire, coalesced.
So when I was at Bessemer, I had run a company previously that was using data in the sort of industrial supply chain world as a SaaS platform. So when I came to Bessemer, I was covering wireless because it was one of the most international sectors when the iPhone and the App Store came out. And so I thought it was sort of the lost cause to try and eyeball the App Store. So I created an algorithm to create a leaderboard effectively on that. And it worked out really well in the beginning for like gaming apps and social media, et cetera. But it was pretty clear that I would need to dive much deeper and cut the data with lots more data sets, which I wasn't gonna be able to do sort of at a more traditional firm. So that sort of launched me on my journey of pulling sort of on the data thread and seeing where that took me in reinventing a new approach to the venture industry.
So heavy on data analytics, right? And machine learning.
Yeah. So I honestly, like in my early years, I was in Boston during a period there was almost no consumer hits in Boston. And I was sort of scouring the universe, trying to find great new companies. But it's very anxiety provoking that you're not seeing all the best companies. You're not in the right rooms. I had frankly run the wrong company, gone to the wrong school, was in the wrong geography. I didn't really have any competitive advantage other than sort of market mapping and trying to sort of think of where the world was going. And so, the application of data was a way of me getting leverage, making sure that I was seeing the best things so I had a fighting chance. And so, candidly, coming from a point of relative weakness at the time, because I hadn't gone to Stanford and been part of the PayPal mafia or Google or whatever it was, the Right Academy companies where all my peers were starting companies. I'd run a company in DC. I was sort of in Wellesley Hills at the time, in a suburb of Boston, working for Bessemer. And it was very stressful to sort of try to think that you were going to be in all the right rooms at all the right times and how to do that. So I used data as a crutch just to make sure that we're tracking everything and making sure that I was seeing the best opportunities. So that started a journey when I left Bessemer. We went and studied over 170 different funds, interviewed over 500 founders, deconstructed the models of everyone from quants to corporate to incubators, accelerators, and the best of breed sort of investors and the venture and private equity side of all kinds. And really down to like the tech systems they used and the source of founders, how they promoted, who they hired, all these types of things. It was one of the most detailed studies of venture ever done, as far as I'm aware. And from there sort of came to the theses that sort of led the foundation for SignalFire.
Interesting. I mean, breaking out, just leaving your firm and doing all that work. I mean, did you have a team to help you do that? Or was it just love to understand more of the genesis there?
Yeah, so I had 6 researchers for a year, but I did the poor man's version of that. I found people who were back at B school, folks like Eugene Chung, who actually was the first hire at Andreessen Horowitz for their platform, was my lead researcher, and he and I collaborated later. He ended up running our platform for a number of years, and just sort of people who wanted to get into venture. 2009 was a period where there were no jobs, and so you really had to go the extra mile to stand out. And so I just went deeper and deeper down the rabbit hole. And so I had plenty of free labor who was interested in venture and used it to its fullest.
I've kind of gone through a similar journey with Alpha, just sort of a unique model. What was the reception from LPs? Did they just immediately be like, boom, we're in? I mean, was that a difficult process?
So the first chapter, a lot of people, I won't say the name, but I met with one of the sort of the founding partners that I thought it would put him the most forward leaning from one of the sort of marquee venture firms. And the meeting lasted literally 7 minutes. He was so offended by the idea and the concept of what we were doing, despite the fact that he'd founded a sort of quant wealth management startup and was at a major brand name venture firm. But it was offensive, some of the concepts that we had that have since proven out, but we definitely got our share of naysayers. And most people thought it was insane to try to apply data to seed at the time. And so, I ended up partnering with General Catalyst and had to Haman Taneja and David Fialco and Joel Cutler, who sort of had been very involved in launching companies like Livongo and Demandware and Kayak in-house. And so I had a very talent-driven strategy to find the best talent as the atomic unit of one of the things that we were tracking that ultimately sort of starts this catalytic process of starting companies. And I just approached them and said, hey, give me $5 million and you don't have a seed program. I'll help you launch into seed. I'll help you find EIRs and we'll build companies together. And then I was going to find somebody on the West Coast to do that. And they wanted to be my national partner, but I wasn't willing to do that without somebody senior from the firm moving out to California. So that's how it all played out. Hemant moved to California. I joined as a venture partner and they were my sole limited in the first 2 funds. And we brought together a motley crew. Nika Bonatzas joined me. And then eventually I was now a partner at E, but would never interviewed there. He came in through my seed vehicle and we worked super hard. We were scrappy and we got very lucky. We seeded Fivetran, Stripe, Coinbase, Zapier, Zenefit, and lots of other companies, Segment, et cetera. It was quite a run. And, they did an amazing job of building GC into now a global franchise, but at the time it had just been in Cambridge prior to that. And then they supported me on launching SignalFire in 2013 when I decided to spin out.
So they really funded your pilot, right?
Yeah, no, it was a great win-win. I mean, they were my sole limited in the first 2 seed funds, and they were the pilot funds effectively, as you said. And they then did a tremendous job of investing upstream in companies that sort of came out of that seed ecosystem that we developed, which in addition to sort of the Stripes that were huge wins for the firm, where they've now invested, I think, something like 700 million. Other things like Snapchat and Airbnb, et cetera, sort of came out of that presence in California and those seed activities, even though we didn't get into those deals until a little bit later. It worked out super well all around. It allowed me to prove concept. And so then when I went to go raise our first institutional fund in 2015, I was super fortunate to have some fantastic LPs like Horsley Bridge that anchored our first fund, have been just fantastic partners ever since.
Well, they're based in Boston too, right?
They were originally spun out of University of Richmond. They definitely have a presence here in San Francisco. I'm not sure about Boston, but they sort of have folks around the country. But they were very quantitative in the way that they looked at the venture world, and very sort of, I think, they're sort of the premier fund of funds and one of the most thoughtful LPs in the industry. And I was very fortunate that we aligned on our vision of, sort of a data-driven approach to early stage investing. And
What would be the pushback? Having more data seems like obvious, like more data.
today it is, I would say that people felt that data would probably be more helpful late stage at seed. How much data is there? This is a talent driven business, like a vision driven business, and data on at the very earliest stages, there's just not enough of it to pick up any pattern recognition. And so that was the sort of the biggest pushback by folks. And, candidly, nobody wants to back a data driven firm before you've built the platform. But how do you build the platform if you don't have capital to do so? And so we had to do a lot of unnatural things. We raised money for the firm, the operating company itself. We are structured like a tech company in a startup in that sense. So a lot of people felt like we were going to be a Mattermark or a Bloomberg, and not a fund, though we were always intending to be a fund. We advised hedge funds and corporates and everything in order to amortize, the cost of the infrastructure. We spend north of $10 million a year on data engineering efforts, not including comp and carry, but it's very expensive to do this. So our Amazon Web Services bill was like half our management fee. The credit card data set was more than the entire management fee. It's a hard effort to get off the ground. And so a lot of people were skeptical that if we put everything into data, how would we be able to hire great talent on the investment side? And so it was a delicate balance.
Bob DeVoli, I don't know if did you know Bob at Sigma?
It's been a long time, but yeah.
Long time, right? I was involved in some deal that called Recycle Bank that ultimately didn't do so well in the end. And I actually didn't invest, which was a good thing. But we had a big debate about that internally, about is it the founder, is it the idea? And Bob felt that it's really easy to change the management team. It's not so easy to change the concept or the opportunity set that you're going after. Would you agree with that or disagree or?
Well, we have a very strong bias to not changing out the management team. I think you lose in the experiences that I've had over the years until something is sort of relatively later stage and commercialized with post product market fit. You tend to get very linear execution, very good execution if you hire correctly, but not necessarily the sort of bobbing and weaving and pivoting to sort of continuously find markets that are evolving that you do from that sort of entrepreneurial founder DNA. And so I'm a big believer in backing founders, in interesting markets, but they need to be sort of heat-seeking missiles, figuring out how the business models are evolving. I mean, and the AI landscape, for example, is transforming under the feet of all the companies building on top of it. And so you've got to be super agile. And so general ideas lead to a lot of sort of follow-on products and movements into adjacencies. And you need to be very agile until you've really built something that has broad appeal and scalability. And that sort of discovery journey, I think, requires very specific DNA that, is that sort of risk-taking, that fast iteration, those types of things that I think, executives tend to be better at the sort of the operating side of things than that sort of fast twitch.
I didn't mean to suggest that as a strategy, changing out management teams was a good idea. It's more about relativity, like in your weights and your data weights. Like if you have an A team, but a B concept or C concept, you can't make a C concept work with an A team. You can have the most pivoting, wild, enthusiastic founder in the world. But if you have a C concept, it's very hard to turn that around. But if you have an A concept and a B or C team, it's a little easier to be like, okay, well, we can upgrade the team a little bit and help them execute. Whereas if your idea is wrong, then that's really more that I was thinking about.
Yeah, no, totally fair. I mean, we have a heavy bias to backing the best heat-seeking founders. And we have the assumption that at the pre-seed and seed stage, the idea is always wrong, at least 99% of the time. And that doesn't mean that it's completely wrong. You have to sort of tack or pivot a little bit to get there. It doesn't mean you have to transplant to completely new markets. So we're looking for exceptional founders in interesting markets where disruptions in technology have the potential to bring impactful change, right? So, and then there's usually an evolution. If you're dealing with corporate customers, they'll give you feedback of what the pain point is, and you may be close to the right pain point, but not the exact pain point, or you may have a wedge with a medium pain point, but then, use that as an entry to get to the major pain points. And so we tend to layer in capital as a result. We tend to sort of back the absolute best talent we can find in the markets that we think are going to be most disrupted. I can give some specific examples of how we think about it. And then pour fuel on the fire as these companies find product market fit and as they find sort of go-to-market motions that work. And so it's an iterative process, but for us, it always starts with the absolute best talent. And in some cases with AI, great data sets that they're differentiated that allow you to build better product. So there's a bunch of ways this has evolved.
Right. So your data analysis isn't so much on maybe that's the catch here is that, I'm trying to be like spending $10 million a year, evaluating founder capability. Maybe that's where the VC founder would hang up the phone and be like, well, you can't really do that. That's a harder, like, there's not enough data points you're going to do evaluating the kid's 8th grade transcript from his teachers, or maybe you are, I don't know.
No, without going into too much specificity, I would say that it starts super people centric and we evaluate many, many parameters of people's backgrounds. Yes, going all the way back to their academic careers, but anything they've done on the job, to open source projects and patents and all sorts of things. And then we're looking at sort of learning velocity. And so we start with great talent and interesting markets. And then over time, the way that we use the data evolves. So it's not the same sort of data sets and the same parameters through every stage of a company's journey. It starts to weight much more to customer behavior patterns and other sort of commercial execution elements, some of which are team oriented, some of which are much more go to market or execution oriented over time. So the weighting shifts from extremely talent oriented in the very beginning to sort of much more blended weightings as you get to different stages of a company's development. And then even then, it depends on what sector you're in. The weighting of your AI team is completely different for a fashion marketplace than it is for an AI infrastructure company or an LLM. And so you have to have the right type of talent for the specific use case, and that it totally depends on the domain. And so we break the markets into thousands of different subcomponents, and the weightings are different for each of them. You need massive scale AI and ML infrastructure in order to do these types of things because these can't be human tuned.
Interesting. You've had a lot of successful companies. I mentioned a few of them earlier. Could you give me one or two case examples just to bring it all into high life? Doesn't have to be very specific. Maybe an exited company like GetAround is one of them. Not the best example because we were an investor there too. But maybe you could tell me what went wrong there someday soon. But it'd be great to just understand, connecting this a little bit more.
I would say that it starts much more with discovery, right? So the end of companies that you're looking at the pre-seed stage, pre-launch stage is obviously orders of magnitude bigger. We're actually looking at pre-formation, pre-company companies, so entities. So it's something like 80 million entities, some of which become companies, many of which do not. And it could be an open source project. It could be an interesting person who leaves a job, or it could be a founder who's still at a company that hasn't yet left to launch their next company. But statistically, based on our algorithm, we project that they're more likely than not to start a company again and be a serial entrepreneur. And so, that first part is sort of finding the needles in the haystack and getting the timing right of when to reach out to people. And we're tracking hundreds of millions of people and many tens of millions of entities. Now, as those companies incorporate and raise capital and go through the phases of company formation, it starts to winnow the number of entities that you're tracking. And then obviously, as you get to the series A and B and whatever, there's fewer and fewer and fewer companies at each later stage of development. And so then you're going much more deeply on the operating parameters of a company than you are on the discovery piece, because the discovery problem becomes less challenging, but the differentiated view into that company becomes more important, but there's more data to analyze. And so you can look at things like customer quality and retention. You can look at things like there's all sorts of reviews and noise and things about companies, whether it be press and PR or, something like G2, which is, product reviews and whatnot. You can see customer credit card transactions and, purchase and, frequency and retention and those types of things. Could be APIs, open source, all sorts of things have activity around them, and we can track all of those parameters. And then also just sort of team quality. Are they recruiting and retaining great people? And these are all the types of things that you can look at a company. That's sort of the beating heartbeat every day of how that company is executing. And as they build momentum, even under the surface, that's the type of thing that we really want to pay attention to and get ahead of.
So you're pre-seeding and seeding a lot of companies. And then as they progress, you'll select the ones that you want to really double and triple and quadruple down based on the data and the performance. Is that accurate? Or
we select and the market selects. I mean, the ones that don't find traction, don't raise A's and B's and large quantums of capital typically. And the ones that graduate and are successful, there's more upstream investment opportunities by the nature of the fact that they're raising more capital on the back of customer success and sustainable metrics. And so there's an inherent Darwinian process to all startups, regardless of the firm's strategy. But we have the capability of going the full life cycle with companies. So while seed is our general point of entry, we're not a seed fund. We have the ability to stay with companies all the way through. And today have, as much as, 100 million invested in a given company.
what's the most surprising thing that you've discovered that everyone thinks is true, but it isn't?
I think the most surprising thing in this journey has been shockingly how much window dressing people have done with data and how not deeply they've actually done it. Being natively born as a sort of data-driven AI native firm is radically different than it's like the analogy I use a lot with folks is if you think about quant hedge funds, all the best quant hedge funds in the world started as quant hedge funds. Nobody started as a traditional firm and transformed themselves. And it's now become sort of vanguard for every firm to say, of course, we're using data. But that usually means they're buying data from a third-party source. And that's no different than, say, Fidelity buying a Bloomberg terminal. Yes, Fidelity uses data as well. But that does not make them a high-frequency trading firm by any stretch of the imagination. And I think the most surprising thing for me is there were a number of people trying this, from Google Ventures to Social Capital, and many others. And most of them, and many of the major firms had engineering efforts to try and do this, but most of them have stalled or shut down or in one way or another. And the fact that there isn't a stronger competitive set is actually the biggest surprise of all of this, because it's become much more consensus that data matters. And yet the competition has diminished dramatically, which is the opposite of what I would have expected.
Interesting. Have valuations become a consideration? Like, you could have all the green lights in your model and company and, they're performing and everything else, but do your models factor that in? 100 times revenue? That's not going to work.
Yeah, that has been the biggest, most frustrating part of all of this is the model and the ability to construct a portfolio. Our models just crush the venture industry in returns. Unfortunately, they are constrained by the actual ability to get the deal done on terms that are reasonable. And so there is obviously a reality to translating a theoretical model or, with sort of the market clearing price of where these companies price if they become too visible, too consensus to too many people. And so we've tried to stay very disciplined. In fact, between 2018 and 2021, when the markets went sort of crazy out of control, we lowered our cost basis in companies by over 20%, when the rest of the market was paying usually between 200 and 300+% more than they had been previously. And so as prices inflated, we shifted earlier. We went much more aggressively pre-seed. We went much more aggressively seed, post-seed, and Series A, and we stopped doing like Series B and beyond. So we shifted valuation risk for company risk and traded, because we just felt that according to the data, the amount of traction these companies and their probability of succeeding was not aligned with the inflation of the valuation. So valuations were ahead of the sort of probable outcomes of these companies. And so what you have to do is react to that market. And the only way that we could see to do that was just to take more company risk and instead of taking valuation risk. And so if the market's overpaying, you need to get ahead of the market and have them pay up on your investments. Whereas, if the market cools, you can buy a lot more company for the same dollar. And, a more advanced company that's sort of farther along on the commercialization path. And so, it's just always, it's helpful to have a perspective of where we are in cycles and not sort of stuck in the consensus and the sort of emotion of trying to compete and win for everything. At the end of the day, you've got to be highly disciplined in this business and get risk adjusted returns. And if you're paying for perfection, none of these companies are perfect. They all go through the ups and downs. And so finding those opportunities to back entrepreneurs at times where you get rewarded when you're right and when you execute, and then we work like hell to support founders to actually achieve their vision.
Wow. Have you found that you've been able to repeal the power law curves or bend them at least?
I can't get into too much detail, but I can just say that our loss ratios relative to the rest of the venture industry are dramatically lower, and that our capital concentration is dramatically higher in our best companies. So the power law dynamic does shift as a result of that, because we're able to keep our losses lower and put more sort of wood behind the arrows of the ones that win. Hopefully that will yield the better returns that we expect, but we fight every day to make sure that happens.
Right. And so your outside folks that you sell your data to, they're not in the private markets. They're all public market types of folks, or?
We stopped doing that. We had to do it in the early years. As we got to critical mass, we stopped doing it. It just was too complicated to explain to LPs and get through sort of conflicts, concerns, and all these types of things. But we didn't have a choice in the early years, because seed funds just don't generate enough cash flow from management fee to really make heavy investment in infrastructure. And so I think that's been the main thing that has limited the amount of competition. And it's very hard for a traditional firm to sort of go in and change their sort of DNA, no different than like GM trying to become a autonomous driving car company. All the moats are in the wrong places. You've got to completely reinvent the kind of DNA you hire and how you compensate people and how you think about, constructing your business model. And, the same is true for the sort of legacy venture firms, and as they are for the public equity firms, trying to become quants. So I think it has to be new companies that are sort of designed from the ground up for the new sort of AI driven paradigm of incorporating that, infusing it into everything that we do. But it's a very hard chicken and the egg problem to solve.
Do you use your models to choose sectors as well, or is that more of a bespoke?
It's hard to predict the future. I mean, the models help us react to sectors where things are getting traction. And so we can see clustering and whatnot. They're less sort of predicted before things start. And because we're so early at pre-seed, seed, where we like to get in whenever possible, but we definitely use it to see where talent is going. And that's sort of one of the things that helps us sort of narrow in on where people are seeing that opportunity. But we also do a lot of macro work ourselves and understanding where there's opportunity, but also really understanding the nature of technology. I mean, that's been one of the biggest secrets to the firm is we're not just a technology investor, we're a technology product builder. So we've built full AI product suites for our portfolio, for our own team, et cetera. So we've been using LLMs since the earliest days and AI long before that. And so we could see the nature of where things were working and not working at a sort of bare metal level, not sort of in glossy, pitch decks, but really at the sort of source code level. And so that has helped us to have a perspective on which applications were going to be near-term feasible and which ones were more in sort of R&D territory. And so, that's where we saw, for example, that AI would be very helpful with the office of the CFO and the back office and administrative things and legal tech and those types of things, which were not sectors we'd ever been active in, at least the legal tech side, because the documents that are output and the amount of bureaucratic load is very high. So we went very aggressively into healthcare because it's a $1.8 trillion bureaucracy, and we've done a ton in the back office of that ecosystem and have really built a strong healthcare team over the last number of years that we hadn't historically had on board as generalists. So we switched into much more vertical specialization, and we went very aggressively into many areas where we felt that the technology was going to enable capabilities that were not feasible before. And we've done that in a number of verticals, but you really need to understand the nature of the tech and what it's truly capable of, not in a demo perspective, but in a sort of actual real world uses in a commercial context or a consumer context. And then aggressively sort of figure out which markets that best applies to and can drive the deepest impact and highest ROI for the customers.
Of your portfolio companies, and this is sometimes a difficult question, picking amongst your children, if you will. Do you have any companies that you think are sort of undernoted, that you think have huge potential, that the press for whatever reason hasn't picked up on, or other VCs haven't really picked up on? Just throwing that out there. It could be stealth, not stuff that's stealth, but stuff that, that might be more out there. That's sort of an underdog, perhaps.
Yeah, I don't know, what I want to point out from an underdog perspective, but there's companies like Stamply or Growth Therapy that I just think are going to be behemoths. And by that, I mean easily $10+ billion companies over time based on the trajectories that they're on, the defensibility they've built in their areas. And some of them have had just absolutely explosive growth already and in profitability in one of those two cases. The one is just poised to just have such a huge impact that people, I think, underestimate at this point. But there are many others in the portfolio that I think are showing signs of just tremendous velocity and defensibility in their areas. Even Up is one that did a big round recently and hit sort of that unicorn status in a domain, again, that we wouldn't have personal injury law, that we wouldn't have sort of seen as a venture backable segment of the market, right? It was not a lot of software being sold into the personal injury law space, but they've just done an unbelievable job of executing and building a deeply defensible position and hugely valuable position in that ecosystem that ends up being, a very, very large category, the largest category of insurance. But, this is data that was all siloed before, and they built a workflow and become sort of a critical infrastructure layer for that whole ecosystem. So there's lots of exciting things there. We've done a lot more in vertical SaaS through this AI journey because I just think you need to build defensibility of data and really understand a unit of labor in these ecosystems and how to just provide tremendous leverage and ROI to those customers. And the really fun part is a lot of your competition is pen and paper or literally Microsoft Word or PowerPoint, Excel, and not sort of legacy tech companies that have deeply embedded positions.
I want to come back to that in just a second. There are a few firms out there like SignalRank, and frankly, a lot of VCs in general that kind of look to other VCs as signals. Do you guys, I had Ed Sim on, from who I've known for a long time, Ed from Bold Start, I've had Hans and Tim Draper, but, Ed is very deep in inception level tech investing. Do you factor some of that stuff in the model? It's geez, if Ed is interested, maybe we should too. Or, I was just curious, does that enter into how you think about things at all, or not really? Or
Let me put it this way. Because we like to get in so early into companies, pre-seed, seed, et cetera, that is almost by definition the scoreboard of losses, right? So if other smart money is already in the company and those signals are strong, I think that's the least differentiated signal. And it's really a tombstone of the ones you missed more than it is an actionable lead on something that you can't pre-seed or seed something Ed's already done. Maybe you could do an A or a B upstream, but that's a small minority.
well, in the same round or the round after, or does it, you sort of see it more as a negative signal then? Is that right?
I don't know that it's a negative signal. It's a positive signal, but I just think that it's the opportunity to get ahead of the market is by definition diminished because Ed is, in that case, in this example, has already sort of been that triage point to narrow the universe to what he considers the most promising company in that particular domain. And so other investors who are LPs in his fund or following the portfolio page of his fund, whatever it may be, or sitting on boards with him and chatting about what he's excited about. And that's sort of the traditional way of doing things, and almost by definition, a lagging indicator. You have to wait for the next round by definition, and we're trying to preempt and get ahead of the market as much as possible. So it's not to say that it's not a valuable signal. It's just a late signal, not a preemptive signal.
Got it. That's really helpful. Let's switch channels back to some of the segments. You mentioned AI and labor saving. How do you think about that? You've seen a few cycles over the last, couple decades. Is this the big one?
I think this is the biggest generational, opportunity in probably humanity. And I don't mean this as exaggeration. I think that most of the general purpose technologies throughout history, whether it's sort of professionalized agriculture to the assembly line to to book publishing or the printing press rather, all of them took a fairly long time to distribute around the world. They did it very progressively. If you look at the internet itself, it bumped around in academia and scientific circles for many, many years, and if not decades, before it started to become mainstream. Crypto, same story. Whereas AI, now it's been sort of building a foundation over the last 40, 50 years, but it's building on top of all of the cloud infrastructure that was created. So the ability to access it from almost anywhere in the world instantly is basically unprecedented in how quickly it is able to be distributed around the world and accessed. And so that is first sort of unique to this technology wave. And then secondly, in some of these use cases, you're seeing monetization at an order or even 2 orders of magnitude higher than productivity software sold historically into these ecosystems, because you're not selling a productivity tool to a worker. You're basically producing some of the work output. So you're going after the labor cost itself, not a productivity tool to the labor that then is an incremental cost. And so if you can monetize at an order of magnitude because of the labor savings, and it's almost every industry you can imagine, to me, it's just an unbelievable opportunity. And it's a one-time first in humanity sort of opportunity to take unstructured data that sits in silos all over every organization in the world, whether that's, storage drives or people's phones or email or systems of record of various kinds, Word files, etc., and basically get a single pane of glass across all of these and break down some of those functional silos. That is also unprecedented. And once that happens, I don't know that ever repeats again. I have no question there will be new technologies that come out that are hugely important. But as far as aggregating and making discoverable and actionable the breadth of information that humanity has created, and I think of the scale at which AI can access and make that summarizable and extractable, that is unprecedented. And the potential impact is so mind-boggling on almost every industry you can imagine. I think it will break down the very nature of organizations and how they are formed and scale. And you'll see tiny companies that are able to replicate scalability of much larger organizations agentically very quickly. And we've seen this with like the venture industry with solo capitalists and things like that can build on much more stack and function as if they were, larger firms themselves. And I think digital franchises, all sorts of vertical applications, it's going to be stunning how much that impacts a move away from large bureaucratic organizations that have all the back office and infrastructure you need and distribution and whatnot. And then as you start to be able to weave this together with AI and platforms, and the unlock there of entrepreneurial activity is going to be stunning. And so I'm very bullish on that potential. And growth therapy is a perfect example. As a therapist, you want to be in the business of helping people. You don't want to be in the business of being a benefits administrator or a moonlighting as a tax accountant or scheduling and rescheduling as client schedules change or acquiring customers that sort of match your subspecialty. And a platform like that is just a massive unlock and just spawns people to go into business for themselves. I mean, you've seen sort of precursors of that with things like Uber and some of these labor markets. But when you're able to do that and then an increasing amount of the work is done agentically, it's mind-blowing how much that could scale.
Amazing. So, I mean, long story short, the labor market is pretty damn big relative to the software market.
If you look at the spend on labor relative to software, it's many orders of magnitude more. And there's so many industries that have been big spenders on services and small spenders on software that have an opportunity to potentially leapfrog what they would have done. And you saw this back in the day with sort of terrestrial infrastructure and wireless, where a lot of countries or continents, in fact, like Africa, Europe, et cetera, that had relatively weak terrestrial infrastructure, were able to sort of leap forward in the mobile wave because, it was just so accessible and cover such huge geographies without that sort of CapEx spend in the same way. And I think you'll see the same thing here in AI with much broader application than just the communication and data layer with this sort of labor layer. And that's probably the largest commercial opportunity in the history of humanity.
So, we grapple with this as well. I mean, in a world, when you say order of magnitude, or 2 orders of magnitude, that's 10 and 100 times, right? Just to let our listeners hear what you mean by that, by orders of magnitude.
Well, today, Even Up, for example, monetizes between 20 and 40x what the software spend was per seat. I won't get into specific numbers, but that's one example. And those numbers are only rising as they become more capable of doing more advanced things and higher value things. And so that's not an exaggeration. We have many real world examples where, you might have spent a couple of $1,000s on software, but the labor on top of that software can cost $100,000 or more. And so, your ability to cut costs, and I think call centers as an extreme example, right? If you can automatically
2-3% of GDP.
yeah. And, if you look at like the companies like Hippocratic.ai that's been trained off nurse calls, the cost of having an AI do a follow-up call to check in on a patient, find their pain levels, and see how they're feeling after a surgery or whatever it may be, versus the cost of a nurse doing the same thing. They're not actually acting and doing healthcare, but they are able to give inputs that then escalates to a human that's credentialed and whatnot. But you're talking pennies versus many dollars for the same sort of information and work output. And if you look at AI scribing, using an MD to input data into an EHR is not only is it causing burnout and huge labor issues with doctors, and there's a scarcity of well-trained people, removing the bureaucratic piece of it has been taken off very quickly. And so I just think there's just a lot of time wasted in email and data input, whether it's a salesperson or a doctor, and the ability to get much more accurate, detailed notes with much better predictions on what the probability of closing a sale or whatever it may be, or understanding the nuance of a patient's answer is just a huge unlock, both of labor to do what they are truly passionate about doing and reducing a lot of the sort of cognitive and administrative load is just a huge benefit in making accessibility more democratized, in reducing burnout and bringing back time that can either be redeployed as leisure or in serving, more customers, more patients, whatever it may be. And so, that's very exciting to me. I definitely recognize that it's not without significant potential labor disruption that we're going to have to navigate as a society of what that looks like and what the future of that sort of social contract is with society. But it's an inevitability at the same time, and something that I believe in the medium to long run will unquestionably benefit society. How we bridge it in the short to medium run with labor displacement and the sort of challenges of that is a huge challenge that we need to take on as an industry and as a society to make sure that we navigate this with the least amount of pain to the rest of the population as possible.
Yeah, I mean, it feels like so far that companies are doing okay with just producing more, serving more customers, driving prices down. It doesn't have to result in like mass unemployment. We had an agrarian economy, 98% of the economy was agrarian 200 years ago. Today it's 1%. So like, it doesn't have to mean that bad things happen just because we're not all farmers. To not speaking to the original Chris Farmer, right?
In the medium to long run, I completely agree with you. I do think that something like autonomy as it rolls out, it's the single largest employer of men in the United States is driver. Like that is going to be something where we're going to have to get very good at retraining and finding ways for people to do productive activities, because I think that's really important for lots of reasons beyond the economic ones. But the speed at which this is happening, I think, is the biggest opportunity and challenge from that perspective of that potential wave of displacement. But I am very confident we'll be able to navigate it to the best and betterment of all society going forward. But I do think it's something that we need to be cognizant of, because I think the technology will be part of the limitation and the innovation and the capabilities and whatnot. But I do think the societal impact will probably be the bigger challenge that will stunt growth if we don't do a good job.
So tell me, riddle me this. If the opportunity is 10 to 100 times software, have you sort of factored into your models kind of like, geez, that company that we would have valued at X, now we should value at Y, just given the market opportunity scope? I mean, is that just curious in terms of like, how are you thinking about that? Because you're talking about, mind-numbingly large jumps in market size.
We have asked ourselves that question a lot. I'm a little old school and believe in high ownership, low cost basis, and that these things are very risky. And you've got to be very disciplined. But it is something that we spend a lot of time thinking about. I think we have tried to stick to our discipline of early level entry and relative valuations. Though certainly prices have inflated, and we are willing to pay up a bit relative to what we did in years past, because of the sort of amplification that you alluded to. I would say that probably the most immediate impact has been that we've gone after more niche opportunities that would have not seemed venture scalable before, that are now venture scalable. And personal injury laws is a perfect example of that, but there's many others because the depth of the monetization is much deeper. The addressable market is much bigger in these industry verticals than it was historically for just software.
Interesting. So in some ways, you just stick to your knitting, and that's helpful.
Yeah, I mean, I think that a bunch of the biggest firms have taken the other stance, and they're deploying huge amounts of capital at, I mean, mind-blowing valuations in some cases, tens, $50+ billion valuations that would have been large cap public equity in eras past. And I just think it's very hard to have a differentiated view at that level of scale of companies. And I just struggle to understand how you get premium returns. And so we've decided to just stay very early, and we have alignment with LPs on that basis. But we have partnered up with LPs to continue to deploy later stage than we did historically because there is still, upside opportunity there. I just want to make sure that as the funds that we have, that we continue to offer premium returns and premium product to our LPs. And frankly, it's the place that I have the most fun at with the entrepreneurs. I love ideation. I love that early, messy sort of finding product market fit piece of it. And I'm personally less geared to helping a company grow from, 100 million of revenue to $1 billion. There's lots of folks that are good at that upstream, and we're happy to partner with them.
Right. Just to get back to another topic that you and I chatted about a couple months ago, actually. And that's the great part about what we do at Alpha is that we get to hear a bunch of this stuff. We were talking about DPI, and that was like the first thing is like, what are you doing about DPI? And, you shared with me a little bit about your thoughts on that. Has your, first of all, it'd be great to get, kind of a recap of that quick thought, if you're willing to share that. But also, has that changed, like with this administration? Like you're thinking about that. So start with the first piece.
So, I mean, I think when you have 10-year funds with 2 1-year extensions, typically in the venture market, and companies are going 15+ years. I mean, I've been in Stripe and Discord for that sort of magnitude of time. Clearly that doesn't align. And that doesn't mean it's a bad thing. These are obviously fantastic companies that are much more valuable than when I invested at seed. But they, but at the same time, you need to figure out how to elegantly and efficiently get capital return to your early capital partners and not just force them to stay, illiquid for what's approaching 2 decades. I think that's a product from a financial perspective that's too long duration. Very few investors can see 20+ years into the future and lock up capital for that amount of time, regardless of the return. And, we need to figure out as an industry how to sort of at least get your cost basis back, 1 times the fund to our LPs in a reasonable time frame along the terms that they committed to when you started, which is 10 years. And so that doesn't mean you're not excited about the company or that you shouldn't stay an investor in the company, but it does mean that you need to figure out how to elegantly sort of hand off the baton to a new set of investors who will take over their positions in a secondary sense, or, people are doing strips or continuation funds, all sorts of things. But that requires a lot of data flying around and often investment banks going out to try and get the best price for that sort of cross section of the portfolio and whatnot. And I think that figuring out more elegant ways to do that handoff that used to be an IPO, but an IPO is no longer at a $500 million valuation. It's more like a $5 billion valuation. It's an order of magnitude more than it was from a market cap to go public, over the last 20 years. And so I think it would be great to get that 5 billion back down to maybe 1 billion through less sort of bureaucratic load and regulatory sort of impediments and whatnot. And I hope the incoming administration find ways to do that because I think it doesn't serve the public. I mean, we're protecting them from themselves by not allowing them to invest in the greatest wealth creation on the planet. That doesn't make sense, especially when you see the appetite in crypto or day trading or lots of other things. And people, I think, deserve the opportunity to have that be a substantial component of their, retirement plan or wealth creation plan or whatever it is. And so I have a real issue. Obviously I don't want people to be taken advantage of. And frankly, there were a lot of people with SPACs and things like that preyed on people who wanted to get exposure to this. And I think we need to do it in a way that's safe, but I do think we need to do it earlier where 95% of the juice hasn't been squeezed by the time a company goes public. And that's basically what's happening today. And I don't think it's a good outcome for society for a couple of dozen firms and their big limited partners to capture the vast lion's share of this wave of wealth creation. I think it's really important to figure out how to have all of society benefit from this. And so, we're working really hard to figure out how to create our own sort of capital markets function internally as a firm, where we either hand off from LP to LP in a seamless way for founders that continues to drive alignment and refreshes the clock or restarts the clock and, gets capital back to our early investors that were there on the highest risk early phases. And then the next sort of phase of the journey is maybe a different investor base. And some people will want to go the whole distance, but giving people the option to get their money back and get off the train, I think is a critical thing that we as an industry need to figure out. And if we don't figure it out, I worry that the venture capital product in the investment universe is just going to be too long duration to be attractive to the vast majority of investors. And I think it will shortchange huge swaths of society that should and deserve to have access to these opportunities.
So are you optimistic or pessimistic about this upcoming next 4 or 5 years? I almost cringed when we last spoke that someone like yourself is spending a decent amount of time thinking about this issue instead of building new and better companies, right? It's like, that's a waste that your time and talent is thinking about that type of stuff. So I'm hopeful, and everyone projects their own hopes and dreams on a new administration. I hope we're at peak illiquidity in the market and that things are going to pull back. And I'm optimistic, actually. I'm finding more and more LPs are interested in getting exposure to the asset class and technology in general. It seems like we might have been peak illiquidity, hopefully. Like, I agree with you, 20 years is a serious amount of time. And I'm optimistic that might change in the next year or two. And it seems like some folks are getting appointed in the right places.
I agree with you. To be clear, Trump was not my candidate, but that's been one of the pleasant surprises I think it's been a real coup for the Libertarian Party, and that both the Republican and the Democratic parties were failing in this regard. And I've got to, take my hat off a bit to some of our peers in the venture industry that are really trying to drive a reduction in bureaucracy, regulatory sort of impediments and whatnot. Now, whether that's actually possible or effective or whatnot is still to be determined, but I certainly applaud them for trying and taking that risk. I think it's a huge opportunity. And frankly, like things like AI further enhance the ability to sort of make some of these processes more streamlined, easier for people to do paperwork and get credentialed to be accredited or whatever it is. And so hopefully it's a combination of rules and less sort of bureaucracy, that the combination really streamlines the load of government services and expense of that to all of society that we pay in taxes and whatnot. I think there's huge opportunities for efficiency gain. The same, if healthcare is, I think, the largest opportunity in the commercial world for AI, I would say government is the largest overall opportunity, because the amount of bureaucracy and painful processes, whether it's taxes or, all sorts of licenses, whether it's, building permits or whatever, and that there's a lot of opportunity for streamlining with technology. But I also think there's just some of it's philosophical that, just having a default tear down the rules, and then we're going to have to add a lot of them back. But this is sort of the Elon Musk approach to SpaceX is, if you don't know first party why that constraint is there, remove it until you find out that, oh shit, we really needed that there, and then add it back in. But a lot of it, if you do it in a thoughtful way, you end up reducing a lot of the regulatory impediments and rules that may not apply anymore. And I think a good house cleaning is always a good thing periodically. And so I'm hopeful that they're able to do so, even though I would have voted a different way.
Yeah. No, I mean, I think there's some sentiment in the Harris quarters too that certain folks in the Biden administration weren't working the way that we needed them to. The FTC chair, the SEC chair. I'm not so sure what she would have done. And as a Gen Xer, I think a lot of things have happened since the election that, Trump really wasn't about. This whole efficiency in government, that wasn't part of his campaign.
I know.
Right? But I think it's the reality. The nice part is that it does feel like the political class is learning a little bit, and we'll see. Well, Chris, I feel like we could chat forever, and I hope we do. I hope we do this again sometime. And excellent having you on the pod.
Well, thank you so much for having me. It was a lot of fun.
Yeah, it was fun. Chris Farmer from SignalFire, CEO and founder. Thank you so much for joining us.
Thanks for listening to the Driving Alpha podcast, where we host top investors to demonstrate how they outperform the market. Click subscribe so you don't miss future episodes. Driving Alpha is supported by Affinity, provider of the CRM for the private capital relationship economy. Affinity knows who has the best relationship with the right startup. Affinity knows. Learn more at affinity.co/driving alpha.